The deep dive is open, and we are jumping right into the single biggest trend defining the market: artificial intelligence.
It's everywhere.
It is. I mean, the stock market has been completely fueled by it, driving valuations to, well, historic highs.
Hmm.
And I think the central question for anyone investing in 2026 is, can this possibly keep going?
Right.
Or are we just bracing for some kind of massive reset?
It's the multi-trillion-dollar question, isn't it? And look, trying to time a bubble, if that's even what this is always a fool's errand.
Always.
So for you, the listener, the practical approach from all our sources is pretty clear. Focus on high-quality businesses.
The fundamental.
The fundamental. You need companies with real, actual value, regardless of the hype.
Yeah.
These are businesses that are either the essential foundation for AI's expansion, or they're just ruthlessly using AI to widen their own competitive moats.
I really like that framing. It shifts the focus from what's the hot stock today to which company is actually essential tomorrow. The core idea we found in the research is compelling, and honestly, it's pretty simple. The world's biggest, most important companies are now completely tied to AI. And for a lot of them, this might just be the start of a whole new growth phase.
It really might be. And so what we've done is we've organized the material to give you a look at the entire AI economy from top to bottom. We're going to unpack 5 examples that really fit that quality plus opportunity profile.
Okay, let's do it. So if we're building this AI economy from the ground up, we have to start at the literal foundation,
The silicon.
the chips that do all the heavy lifting. First up, Taiwan Semiconductor Manufacturing, TSM.
I was actually a little surprised to see TSM featured so heavily because they don't design the flashy AI chips that get all the headlines.
Right, they're not NVIDIA.
No, but their role is maybe even more critical. TSM is a foundry giant. They manufacture those advanced chips for basically everyone: NVIDIA, AMD, Apple, you name it.
They're a choke point.
A critical choke point in the entire global tech supply chain. Without TSM, honestly, the whole AI boom just stalls.
The way the sources put it, TSM is almost like the world's most essential utility company right now, and that has to translate into immense pricing power.
It does. And what's interesting for anyone worried about diversification is that a bet on TSM isn't just a single AI bet.
That's a great point.
They make chips for a massive range of markets. Yes, AI is huge, but so are smartphones, 5G, autonomous vehicles. So if AI spending cools off for a minute, they have all these other pipelines still feeding them.
And you can see that in their financials, really.
Oh, absolutely. The demand is just insatiable. In the third quarter of 2025, revenue grew, get this, 41% year over year.
41%. For a company that mature, that's insane.
It's insane. But you have to look deeper at the profitability because that's where you really see their advantage.
I saw those numbers, and they're exceptional for any manufacturer, let alone one this big. A gross margin of 59.5%.
Which was up from the year before.
And the operating margin was 50.6%. I mean, that's the physical manifestation of an irreplaceable global choke point. That is pure pricing power.
The ability to make $0.50 in operating profit for every dollar of revenue means they just generate these massive, durable cash flows they can reinvest.
So what about valuation? Because that's where the story can fall apart.
Well, it's trading around 31 times trailing earnings, which, it doesn't feel like an irrational bubble. For a company that is this central to all of modern computing, that multiple suggests it's being treated like a high-quality industrial leader, not a hype stock.
Okay, but let's pause on that. We have to bring up the big risk, the one everyone talks about with TSM. Geopolitical risk. Its concentration in Taiwan. How do you weigh that reality against the financials you just laid out?
That's the tension, and it's absolutely real. The sources suggest that the market has, for the most part, priced that risk in. But there's a strong counter-argument. They're diversifying. They are actively building these incredibly complex fabs in the US and in Japan. It's immensely expensive. It takes years. But the long-term goal is to de-risk that supply chain. It's a slow-motion hedge against their biggest risk.
All right, so we've got the Silicon Foundation. Now we have to move up the stack to the companies that buy all those chips.
The ones who turn that raw power into something we can all use.
Exactly. The ones building these massive digital utilities. We're moving into the world of the hyperscale players.
Hyperscale. It just means the handful of trillion-dollar tech giants that basically run the global cloud. If AI is a rocket ship, the hyperscalers are the launch pads. Let's start with Alphabet, GOAG.
When you say Alphabet, most people immediately think Google search, and that's still their anchor, right? Something like 90% of the global market.
Still 90%.
Yeah.
And what that means in an AI context is that it creates the ultimate data moat, a feedback loop.
Explain that.
Well, every single search, every interaction on maps, every ad click, it all generates these huge volumes of unique data. More data improves the AI models, which improves the search results, which gets more people to search.
And the cycle just reinforces itself.
Relentlessly. That massive data set is the fuel for everything they do in AI.
And it's highly monetized, of course. AI isn't just making the search engine better, it's deep inside their ad business.
Oh, totally. They use it for better ad targeting, boosting engagement on YouTube, making the whole network just more valuable over time.
But the story's getting bigger than just ads now.
It is. They're now aggressively pushing their Gemini large language models for everyone to use, consumers, businesses. They're positioning themselves as a major AI platform, not just an ad company. It's about building the next core business.
And from an investor's perspective, it feels diversified. You're buying the search engine cash cow, the dominant video platform in YouTube, and the world's biggest mobile OS in Android. With the stock around 31 times earnings, the argument is pretty clear. It's a durable cash engine, plus this massive diversified AI upside. It's a safe way to play a revolution.
And right next to Alphabet, in that hyperscale category, you have to talk about Amazon. And their AI story really runs through Amazon Web Services.
AWS.
AWS, the biggest cloud provider on the planet, with close to a third of the market. Now, this scale is so important because it creates deep, deep customer entrenchment.
The switching costs.
The switching costs are monumental. Once a big company moves its entire IT infrastructure, all its data, all its apps onto AWS, trying to move is like, well...
It's like trying to move your entire digital life from one service to another, but 1,000 times harder.
1,000 times harder for a Fortune 500 company. And Amazon's leadership is so clear on this. They see a huge runway ahead. They keep saying how much computing spend is still on premises in old corporate data centers.
So they see this huge migration to the cloud that could happen over the next decade or two.
Exactly. Even before you factor in all the new AI applications.
Yeah.
And this is where their financial commitment is just staggering.
How much are we talking?
They're planning to invest over $125 billion in AI development in 2026 alone.
Wow.
That's more than any competitor has publicly committed. They are betting on long-term dominance.
And we're already seeing it pay off. AWS growth actually accelerated, right? It's back above 20% year over year.
It is, which suggests that all that heavy investment in infrastructure is starting to pull in more revenue again.
So the bull case with the stock near a 33 PE is that you're buying this multi-headed growth machine.
You've got AWS, you've got the fast-growing and very profitable ad business, and you've got the e-commerce and logistics network. If you believe in that multi-decade cloud story, plus AI, Amazon is central to it.
Okay, this is where you make a sharp pivot. We've covered the backbone with TSM, the big utilities with Alphabet and Amazon. Now let's look at the established platform leader and then a total industry disruptor.
This is where it gets really interesting.
First, we have to talk about NVIDIA. NVDA.
Right, NVIDIA, the undisputed standard setter. But we have to acknowledge a kind of dual reality here, which the source material captured perfectly.
Okay.
So on one hand, yes, the growth rate might be slowing down from those extreme, almost impossible levels we saw at first.
It had to.
It had to. And yet, the company still has this powerful and very sticky ecosystem advantage.
Let's just tackle the elephant in the room right away. It's trading at around 47 times trailing earnings. That's a lot of valuation risk.
It is.
So if growth slows down faster than people think, there is very little room for error at that price. So the question is, how sustainable is their advantage when everyone is trying to build chips to displace them?
The sustainability all comes down to the software, not just the silicon.
CEA.
CEA. The core advantage isn't the GPU itself, it's the whole integrated platform. The software, the tools, the libraries, hundreds of thousands of engineers have been building on it for over a decade.
So those switching costs again?
They're enormous. You can't just unplug an NVIDIA chip and plug in a competitor's tomorrow and expect it to work. You'd have to re-engineer everything.
So the moat is sticky. But the counterweight, the reason it's still on this list, is the earnings potential analysts see.
That's the other side of the coin. They believe NVIDIA has so much pricing power that its earnings per share could more than triple through 2028.
Triple?
More than triple. If they deliver anything close to that, that high starting valuation starts to look a lot less crazy. It's a high-risk, high-reward play for sure.
Okay, now for our final name, and this is a completely different kind of AI play. We're moving away from data centers and infrastructure. Lemonade, LMND.
This is such a great example.
It's less about building the AI engine and more about applying AI inside a legacy industry. In this case, insurance.
It's a textbook disruption play. Insurance is one of the oldest, least digital industries out there.
Bogged down in paperwork.
Exactly. Lemonade was built from day one with machine learning at its core, not as some add-on. They use AI for pricing policies, for detecting fraud, for handling claims instantly. It's built for younger, digital-first customers who hate the old way of doing things.
And the key for any disruptor is adoption. Is it working?
It seems to be. Their key metric, in-force premium, which is just the total value of their active policies, rose a very strong 30% year over year. That shows they're gaining real momentum.
But with these smaller disruptors, it always comes down to profitability. Can they actually make money?
That is the long-term bet. The thesis is beautifully simple. As Lemonade gets bigger, its AI models get more data, and they just get better and better at assessing risk. They learn how to pick good customers and avoid bad ones.
So their unit economics should improve over time.
Radically. And this is the trigger point for investors. Management expects to hit adjusted EBITDA break-even this year. If they do that, the whole story around the stock changes overnight. It goes from a pure growth story that just burns cash to a growth plus improving profits story. And that transition can drive huge moves in a stock like this.
It really connects back to the main idea, doesn't it? AI is an enabler. TSM enables the computing. Alphabet enables data monetization.
And Lemonade enables a more efficient way to run an old-world business. They're all riding the same tech wave, just at different points in the value chain.
So wrapping this all up, what does this mean for you? We've looked at 5 completely different ways to get exposure to the AI theme.
Right.
We started with the manufacturing muscle of TSM, moved up to the cloud giants, Alphabet and Amazon, then the platform dominance of NVIDIA, and finished with the industry reinvention at Lemonade.
And the synthesis is pretty clear. If 2026 is another explosive year for AI, all these companies are positioned to do well. But if the market cools off, if valuations reset, the sources suggest focusing on those higher quality, more diversified models.
Like TSM centrality.
Or Alphabet's data loop. Those will likely hold up much better than the pure hype trades that don't have that strong foundation.
Yeah.
Quality matters when the ceiling drops.
Absolutely. The goal here was never about chasing the fastest moving stock, but about finding the most durable businesses being powered by this revolution.
Right. And we've seen how Lemonade is using AI to rebuild the insurance industry from the ground up. So the final provocative thought for you to explore is this. Which established, less digital industry is next? What sector, beyond what we talked about today, is most ripe for a complete AI-driven reinvention? Because that's where the next wave of disruption is going to happen.